Good afternoon, Chairman Nelson, Ranking Member Collins, and members of the committee. Thank you for the opportunity to testify today. I'd like to begin by sharing a couple of comments from former payday lenders about borrowers receiving Social Security or other federal benefits. One former manager of payday loan stores described the industry's affection for these borrowers, saying, "These people always get paid, rain or shine. They will always have money every 30 days. A former employee of Advance America, the nation's largest payday lender, said, "Borrowers receiving Social Security or disability payments would come in for a small loan and write a check to the company dated the 3rd of the month, when their government checks would arrive. All the Advance America employees were required to come in early on that day so we could quickly cash their checks and wipe out their checking accounts." Older Americans are particularly attractive to payday lenders because of their steady stream of benefit income. It's not surprising that a study commissioned by the Wall Street Journal found that payday loan stores clustered around subsidized disability and senior housing. Payday loans are aggressively marketed as short-term loan, a quick solution, but in reality, they quickly engulf most borrowers in an expensive cycle of long-term debt. Though their loan is typically technically repaid on the due date, the repayment of the loan plus the fee does not leave borrowers enough money to pay for necessities like rent or food for the rest of the pay period or month. So borrowers are forced to renew their loan or reborrow before the end of the next pay period, paying a new fee each time with no reduction in principal. CRL's research has found that payday borrowers remained in debt an average of 212 days of the year, and that 76% of all payday loans are made within 2 weeks of a previous payday loan being repaid. 82% of all payday loans made within 1 month of the previous loan being repaid. And these findings include data from states that have implemented so-called best practices or safeguards that purport to stop the debt trap but clearly don't. Ultimately, about half of payday borrowers eventually default, many after spending months or years in debt and paying fees that far exceed the principal borrowed. Research has shown that payday loans cause serious financial harm to borrowers: delayed medical care, paying other bills late, increased likelihood of bankruptcy. And these harms are particularly acute for older Americans, many of whom are already struggling with a decline in the value of their home and retirement assets, and who often have less income and a shorter time horizon to recover from financial shortfalls. In a disturbing trend, a few banks have now joined the ranks of the payday lenders. We know of 6: Regions Bank, Fifth Third Bank, Wells Fargo Bank, Bank of Oklahoma, U.S. Bank, and Guarantee Bank. These banks make payday loans even in states where laws clearly prohibit payday lending by non-banks. Banks call these deposit advances, but they are designed to function just like any other payday loan. Bank payday borrowers end up with 13 loans a year and spend large portions of the year in debt, even as the banks claim the loans are intended for occasional emergencies. Our research found a striking number: over 1/4 of bank payday borrowers were Social Security recipients. On average, banks repaid themselves 33% of the borrower's next Social Security check to repay the loan. Though only a few banks make payday loans today, the threat that payday lending by banks becomes the norm is very real. We are at a tipping point. As already noted today, the OCC and FDIC, recognizing that this product poses both safety and soundness and consumer protection concerns, recently proposed guidance that would address the central problems with bank payday lending. We urge these agencies to continue to issue finalized guidance that preserves their proposal's key provisions. The Federal Reserve Board, the prudential regulator for Regions Bank and Fifth Third Bank, did not issue the same proposed guidance. We continue to urge the Federal Reserve to do so. The board did, however, issue a supervisory statement, the content of which should compel Regions and Fifth Third to make meaningful changes to the product that eliminate the debt trap it's been shown to cause. To our knowledge, the banks have not indicated plans to do so. The CFPB's recent extensive study of storefront and bank payday loan data both confirmed and expanded on prior research finding that payday lending puts borrowers in a debt trap. The CFPB has indicated it will use its authority to address this problem, and we urge it to do so. 22 states, home to over 40% of all Americans, have decided they don't want unfettered payday lending for their residents. As mentioned earlier, Congress, with the leadership of Chairman Nelson and at the urging of the Department of Defense, decided 7 years ago that payday lenders should be prohibited from making payday loans to members of the military. Payday loans affirmatively harm rather than help older Americans. They affirmatively harm rather than help Americans of all ages. We thank you for holding this hearing today, and we ask that you support ending the payday lending debt trap by banks and non-banks alike. Thank you.
Thank you, Ms. Borné.